All right. Good morning. Good morning. TGIF, huh? We made it. Got some Fed speakers today and really a light economic day after what we've been seeing. The big thing today is that narrative that I've been talking about. I said, listen to what they're talking about because they very likely are trying to get something across, right? They're going to sing from the same hymn book and kind of pound the table and get a narrative across. And it really seems that the narrative is they want to raise rates more. It's not a surprise. They're just drilling it home. We did see a significant move in the dollar last night. It's still below 105, but it is moving in the right direction if we want to see the S&P leg down out of this range that we've been in. At this point, I'm on the bandwagon with everybody else that says, I don't care where we go. Let's just go somewhere already. Just do it. So hopefully we get that starting next week. It's OPEX. If you look at which Friday we're on, it's the third Friday of the month. That is options expiration, right? That's OPEX. It's always the third Friday of the month. So there is a little bit of an expectation that next week, starting on Tuesday, because it's a holiday Monday, that next week we will finally be doing something different. And we'll have to see, of course, but gives us hope. If you think about this August pivot, whether you're looking at the ES or the Dow or Russell, NASDAQ, the ES is a long ways away from that pivot. It never really revisited it after we set that high back in August of last year. The Dow, on the other hand, set that high in August, made it above that in December, and then just recently came back up in February on Valentine's Day and hit that level again. When we think about how far something has to fall, the Dow has more room to fall than the S&P does since it ran up higher. So, if you are looking for a short, shorting the things that have already gone up a long ways seems like a better idea than shorting something that's sitting either at the lows already or is making new lows already. Something to consider when it comes to the indexes, right? And the small caps too. I don't have them on here, but certainly worth looking at that August pivot on the Russell. So we can see Asia closed down again today. It's been a consistent, persistent move to the downside. No changes there. And Europe's getting a little bit of a pullback now. If we think about this pivot point breakout from January 16, then we'd be kind of anticipating a Busby move. WTI on the left, Brent crude on the right. The range top held, and we've already started making our way back down towards the bottom again. The low that we had set back in December has not yet been challenged again. We had front running in early January and then again in February. So, if they keep front running like that, the range is going to get so tight, we're going to break one side or the other anyways. But my expectation is that we're going to break these last two pivot points and retest that December low. There's no auctions today. It's the first day in quite a long time. By 10 a.m., we'll have all the econ that we're going to get. And other than some Fed speakers or random news that we can't see coming from here, the day is going to be wide open. Since it's 0 day across the board in everything, it's something to consider. What would you want to do a 0 day on today? Because everything has a 0 day today. We can see that volume is back into a normalized range. We're back above 100. This kind of implies that there's nothing to wait for today. It's kind of what we've been talking about. It's just nice to see it confirmed. So volume in normal ranges, we just turn that off. Get it out of the way. We have an MDP this morning and we are a long ways off. So MDP is a missed daily pivot. Pivots are all the way up here, 41.16, 41.19, and we're below, 41. So we're a long ways off. MDP is a trade strategy, but you can also use it for technical analysis, which is what I tend to do more often than not. Use it to provide context and understanding of the situation. Markets hit their pivot point more than 80% of the time. So when we're doing the other 20%, it's worth noting. It's worth thinking about what we can do with it. What can I do you for, right? We do have one more low from February 10. And then below that, we're going to be back down into an older box. Yeah, I guess not. Let's call that box 40-30. So we got a little ways to go, right? Another 30 points. It's like maybe a little gray area. Let's just look at the volume profile. Maybe get a little context out of it there. So as I discussed the other day, we were going to lose that volume from the left side. And if we didn't get below this pivot point, then this pivot point was going to be the new low of the range. Now we're in a significantly narrow 10-day range. It's not the smallest we've ever seen, but certainly giving it a run for its money. We're at the bottom of the box. When we're at the bottom of the box, we have every expectation of going to the top of the box. And when we're at the top of the box, we expect to go to the bottom of the box. We have a classic D-shape volume profile, and we are below the point of control. If we were to climb back above 4,100, we should be able to move back to the point of control relatively easy, which is also a VPOC 4,130. Or not a VPOC, a gravity point, cog line, 4,130. We do have a VPOC from yesterday, 4,107. And we're already seeing next week's range. It's not set in stone yet. Those lines are going to continue to move with price through the day today and will lock into place at the end of the day. But we can kind of get a feel for what they're pricing in next week. We can see already that the size of the box is bigger than the size of the box that we had in the week that we were just in. If we continue this move to the downside today, 40.40 is the expected move low. And it's really close to the anchored VWAP on the year. Now we've been below that level already once this year, came back above it. There was talk yesterday about the 4,100 being a gamma flip level. And I mean, we are below that level now. Thankfully, the options that they use are weekly on that context of selling into selling and buying into buying. They're very short duration stuff. Right, there was 58,500 puts sold yesterday at the 4,100, which equaled around $3.4 billion of notional to hedge on the move from 4,105 to 4,095. So they're going to either need to sell a ton of puts to drive this back above 4,120, or it's just going to break loose. But with OPEX today and the start of the new week, you know, right around the corner at the start of the whole thing, just starting all over, right? Options wise. If we can make it through the day without crashing and burning, should be good in the next week with just a normal selling system. A full ADR move today would only get us back to the top of the range. But we have more than a ADR today. We have a market maker move today as well. 0.62, which isn't as bad as what we saw the other day. You know, there was a market maker move of over 1% the other day. Still, if we put these two together, we get 2.2. And the likelihood of only going 2.2 as opposed to 2.5, we're much more likely to go 2.5. So one thing you can do to kind of resolve that is you can start where the ADR line ends way up here, that would be 1.6. And just keep going. Another 4% would be, or 0.4 would get us to 2. And then another 0.5 from that. So 0.9. That's 4,200, which is really close to the roundy, the voodoo line. I think there's a spot gamma level there. Yeah, 4,200 is a call wall. We won't go above that today. If we do, it would have to be something really big, like an end to the Russian conflict or something like that. Like it'd have to be a game changer to get above 4,200 today. The low side of the ADR is 40.28. And again, from that, we can just continue on 0.9. 39.92. I don't think we have anything at 39.90. There's no cog line. It's not a put wall or anything like that. 3,900, yes, there's a put wall at 3,900, but that's another 90 points away. We have a VPOC at 39.88. That's it. That's all we got. All right, the Bitcoin rally kind of faded out a little bit yesterday. This hasn't been the only driver for what's been going on, but it makes a great representation as a proxy, right? Consider Bitcoin the riskiest asset you could trade, liquidity wise, that it's risky and it's liquid. And so holding it, seeing it continue to expand significantly. If you go out and look at like a regular Bitcoin chart, the Bitcoin futures and the run that we've had there, and we're just finally starting to see this curl over a little bit. Now it's just rolled over. It hasn't signaled a short or anything like that, but it certainly took some of the momentum away from that drive that we've been seeing in the rest of the market. All right, we're on the fourth green weekly candle in the dollar, in the Dixie, the dollar index. 105 has been a benchmark level that we're kind of aiming at, using a little bit of parity, trying to identify, how far would the dollar have to go to leg down the S&P. And 105's kind of been that line in the sand. So if we can definitively get above 105 and close, and then how we open next week, whether we are gapped up or gapped down, it's going to have a lot to do with where we kind of go from there. If you look at the Dixie on the daily, I mean, that's been a significant move in the last 4 days. 2%. So kind of want to be watching this today, see if it's going to back off even remotely a little bit, or if it's going to continue to do that drive. What we used to have, say most of 2022, for an example, was that if the dollar, moved up, the S&P was immediately moving in the other direction. There was a beautiful inverse relationship. Well, it doesn't last forever, and it's gone now. Now we've got to use these zones or levels or ranges. We're still going to need the VIX above, say, 22.5, maybe 23, before we can consider really seeing any effects from this coming into the S&P. All right, nat gas is down again today, along with Bitcoin, KWEB, and emerging markets, gold. Now, the gold part makes sense. We're continuing to see that rise in the dollar. We're going to see US dollar Japan go up, and when that goes up, dollar goes down. So yeah, that makes perfect sense. There's still a lot of strength out there, and I kind of want to stress this, that the buying has been kind of wild. Yesterday, for an example, in Tesla, this thing opened down yesterday and rallied right back up again. Had car recall news, fell down, and then rallied right back up again. The only reason this thing went down is because the rest of the market went down. Otherwise, even recall news didn't stop this thing. It just went right back up again. What you want to be watching for today, let's just go out to a daily and see if we can find an example of this. So we're gapped down in the pre-market. We had a flip over day yesterday. We need to be aware of a day like this. Now, I don't think it's going to end up this big of a recovery, but the point is how we had gapped down, and then it started to look really bad, and then everything just ripped back up in the other direction. So if you kind of think about where we had closed the night before and where we had opened the next day, and then that absolute just rip your face off rally. When you have a gapped down market that recovers and rallies back up, Usually the gap down catches everybody off sides and then starts to squeeze them. And then, you know, if you're short, you've got to buy back to close. Your buying adds to the buying, and the buying just gets even more out of control. And it's just this massive ripping rally. I don't know that we're going to get one of those today. I'm not saying that we're going to get one of those today. Yep, it is OPEX, but that's not the reason for the warning. Just being gapped down in this overly exuberant bullish market is kind of all we need to see a move like that. Shenanigans, right? I showed a picture yesterday of this 5-day, 5-minute. And this is classic. I mean, you can look in the book, Wyckoff, where he talks about this, where you have a gap down in the pre-market, and then it rallies back up, but it doesn't rally as high as the previous high. And then it gaps down and it rallies back up, but it doesn't breach the previous high. Well, if you think about that on a daily chart, what is that? Lower high and lower low, lower high and lower low. The very definition of trend. But you have to convince people to participate. Either you need their positions or you're trying to sell them your positions, right? You're either trying to find liquidity or you're trying to provide liquidity. So shenanigans. We're gapped down again this morning. All they would need to do is flip that sucker over and run it right back up again. In fact, there's an example. I didn't have to look all the way back there. There's an example right there. We closed here, we gapped down to here, and then we rallied right back up again with a follow through the next day and a follow through the next day. Although, you know, we did pull off of that high and closed down lower inside the day by the time it was all done. But a nice little turnaround, right? So it closed there, open here, and recover. I don't know that it's going to do that, right? I want to just continue to stress that. I'm not saying that this is going to happen, but, you know, close there, a minor gap down lower, drop a little more, and then up we went. So when we gap down, I'm more bullish. If we gap up, I'm more bearish. It's hard not to keep that bias all day. You've got to be able to let it go and run with the move, go with the flow. But instinctively, my first blush reaction is if we're gapped down in the pre-market, I'm looking for a move out of it to the upside, not the downside. Depends on the gap, right? And depends on where that gap is located. For us today, it's going to put us right into the bottom of this range. I mean, we're not gapped down that far, but this move through the morning gives us an opportunity to retest the bottom of this range. All right, Spot Gamma said their expectations are the market could weaken around OPEX. It's because of net call positions across index and stocks are expiring, which has historically led to some mean reversion and consolidation of gains. They anticipate the weakness remaining into early next week and or a test of 4,000, whichever comes first. For a break below 4,000, we believe that the markets would need an additional catalyst, a hawkish Fed, bad data, etc. So to get below 4,000, and we're only talking about, 40.55, this pivot from back here on the 10th. They're referring to even farther down at 4,000 and saying that that's very likely going to hold the line. So we talked about 4,200 and we talked about 4,000. We've got some very, very strong lines in the sand. And they may seem very far away, like 4,200 is all the way up here. Are you kidding? And 4,000 is all the way down here. Yeah, but we're still in a bear market. And in a bear market, price can move. The market maker move has increased by 10%, a tenth of a percent since I started the briefing an hour ago, half hour ago. %40 of the S&P is down at least a half of a percent this morning. Now that's not bad. You know, when I put the morning briefing together a few years ago, I used a half of a percent as my benchmark, and I've been using it for a long time, but I developed all of the metrics for the morning briefing when we weren't in a bear market. And I'm really starting to get to the point where 1% becomes my starting point, not a half of a percent. I don't like changes though, so still kind of debating on it. For things that's moved a half of a percent, there was a pretty good list. 40, it's not bad. But things that moved 1% this morning, I see a couple of FANG names, Meta, NVIDIA, but otherwise, that derailment news, there's been a second railroad incident, and we're seeing some railroad names on here. But otherwise, it's energy, some semiconductors. It's just kind of spread out, right? No real theme or narrative to this. So that's the S&P. Flip it over to the NASDAQ. 20% of the NASDAQ is down at least 1% this morning. Led by Moderna, but also PDD, which is one of those China ADRs. JD, another one, is on there. So I'm seeing quite a few semiconductor names, which makes sense, right? And it kind of fits in with what SpotGamma was talking about. Things that really have run in the last 2 or 3 weeks, or say even maybe a month, they're likely to get whacked now, as we're probably going to see a significant level of profit taking. NVIDIA, being a part of the FANG names, the monsters of technology, is down nearly 3 times as much as the rest. Right? Google, 0.5%, Microsoft, 0.5%, Amazon, half, Apple, a little more than half, NVIDIA, 1.5. Fits in with those chip names that we were talking about. AMD, Intel, even Texas Instruments fits as a tech name, semiconductor name. Looking at the S&P 100 though, or at least our bastard version of it. Deere with earnings. They must have done nice. A lot of gray here, right? Which implies they really haven't moved enough to change the color scheme. And no real theme stands out here, even in finance, which we saw some significant moves in finance the other day. Yeah, looking at what was doing the best in the last few days compared to, what's getting whacked today. Bitcoin, nat gas, USO for energy, the KWEB constituents, and then chip names right behind that. You want to watch FXI for an opportunity. Looks like we're going to close this gap at 29.32. We're already gapped down below this structure here. So we broke through the 50, had a little consolidation, and now we got the opportunity to close this gap from way back here. That could get us back inside the box and hopefully, get below that $29 level. Certainly worth a watch. This is the inverse of US dollar Japan. Or US dollar China, excuse me, not Japan. So we've got nothing this morning, even trying to hit things like pot stocks or the EV market, crypto. Crypto's the only one that has like a split ledger. Mara, SI, Riot, they're the ones even slightly green. Everything else across the board is not. So if this selling is to continue, I would focus on these names that are green, because again, I'd rather short the high than, short the low. All right, so really big picture, that's what we want to focus on, is this range, breaking below it, and how far we expand beyond that. Looking at the ES, we're already at that pivot that I had marked on the S&P, right? It's the same pivot, the 10th. So we're going to be challenging that low this morning. Then we got this kind of wishy-washy area, this level in red. And 40.37 is the next level down below that has any real connotations to it. Now, it's worth noting, I haven't looked at T1 alpha, and I haven't gone through all of the levels in spot gamma yet this morning. So there could be something between these two, something that exists in this red area. There's a candle low that ties into a candle high. So a line at 40.47 that you could add. And 40.47 is a level that I've given a shout out on recently too. So it's not a new level. So a break of 40.62 gives us 40.47 and then 40.40. Or 40.37. 47 and then 37. Otherwise, that's a wrap, guys. Enjoy your weekend. Be careful. Be safe. Remember, we start the new week on a holiday. And I'll see you guys next week.